Welcome everyone to today's training on velocity banking. We're the National Real Estate Investors Group, and my name is Bill Omi. I am going to be your host today. I am an investor, a coach, a lifetime student, and most importantly, a value creation expert. So let's get started. Now, why should you even listen to this webinar? Why should you listen to what we're talking about? Well, I'll give you a couple of reasons. First of all, I'm a full-time real estate investor and a value creation expert. Second, I've completed over 100 real estate deals. I control 44 properties, and I've generated $3.5 million. My business and my business model was unaffected by the 2008 crash. In fact, while other people were going broke, my business model thrived. I got some great REOs, and the REOs are bank-owned properties for pennies on the dollar. And if you're a landlord right now and you're not realizing a 30 to 50% cash-on-cash return on your rentals, well, listen up, because we're going to talk about how you can do that using the velocity banking strategy. And finally, I'm an honest guy. I don't have a trail of tears in my history, so you're not going to find bankruptcies or lawsuits or foreclosure or other drama. I'm just a good old person that makes money every year. Now, who in the audience is a real estate investor? So raise your hand if you're not an investor. Okay, people with your hands raised, let me ask you a question. Do you live in a house? You do? Well, guess what? You're a real estate investor. You just might be paying on somebody else's investment. So everybody here, unless you live in a car, right, under an overpass or something, you're a real estate investor. The question is, are you making money off that investment, or are you making somebody else rich off that investment? Now, let's talk about financial efficiency, because this is important. Most folks operate under low financial efficiency. What is that? Well, that means that 33% of your cash flow, the money you earn, is paid in taxes. 33% goes to interest to the banks for all of the debt that you're in, and 33% is available for living. High efficiency or high financial efficiency folks operate like this. They pay about 10% of their cash flow into taxes, 10% into interest, and 80% is available for living. Now, once you get started with this, we're going to teach you how to grow this pie, maintaining those ratios so you're still only paying about 10% taxes and 10% interest. But now you have financial independence. So today we're going to talk about the interest equation. That's what we're going to concentrate on this presentation. Now, velocity banking. Let's talk about velocity banking. Would you like to pay off a 30-year mortgage in about 7 to 10 years using your existing budget? Would you like to pay off your student loans, your credit card debt, and other loans in record time? Save hundreds of thousands of dollars in interest, and at the same time increase your monthly available cash flow. I know that sounds impossible, but it's very possible. And lower your interest payments without refinancing. Improve your credit score, and do all of the above using your existing budget. Would that be of interest to anybody on the line? Well, if it is, let's get started. Okay, common banking principles. These are things you have to learn in order to participate in velocity banking. One is that loan interest is accrued and compounded daily. Next, there's two types of debt instruments that most banks offer. One are loans, installment loans, which you're all familiar with, but the other are lines of credit. So the difference between loans and lines is you can make payments, but you cannot make withdrawals from loans. So right now, if you have a car loan or you have a mortgage, you can make your payment every month, but if you need the money back, too bad, you can't get it. But you can make payments and withdrawals from lines of credit. These are bilateral instruments. In other words, you can go both ways, put money in and take money out. Loans tend to have fixed interest rates, where lines tend to have variable interest rates. Now, Fortune 500 companies have been using this velocity banking strategy for years. In fact, homeowners overseas have been using this strategy for over a generation, but just not in the US. So if you look in Australia, Australians tend to pay off their homes in 5 to 7 years, whereas US debtors have debt for over 50 years. What are we taught to do in the United States every couple years with our debt? Refinance. Oh, refinancing is the worst thing you can do to pay off debt. It's deceptive. You save $30 a month and you pay an extra $30,000 in interest. So, how does this all work? Well, let's do some diagrams here. Your cash flow is worth a fortune. The question is, are you capturing that fortune, or are the banks, the corporations, and the government capturing that fortune? Let's look at how most people live their lives. Most people start with a checking account. Into the checking account goes their earned income from their job. Out every month comes their expenses. In addition, if they have any amortized debt like a mortgage or a car loan or student loans, they make a monthly payment on those loans. This is poor cash flow. This is low velocity. It allows other entities to make a lot of money off you. So who benefits here? Wall Street, the banks, corporations, and the government. Okay, this is your life today in many cases. Now, let's change this diagram. Let's change how you handle your cash flow, and we're going to replace a checking account with a revolving line of credit. Into the line of credit, you'll still put your earned income, you'll still pay your expenses, and you'll still make your monthly mortgage payment. But let's add something that increases your velocity. We're going to make periodic principal payments to the mortgage or to that loan. So every month, you're going to take a chunk out of that line of credit, not every month, every several months, and make a payment. And we'll show you the details in a second. Now, this is high velocity cash flow. In addition, you're going to start generating other income or other cash flow, such as rents, maybe notes on mortgages, maybe business income. And this is passive income. This is what gets you out of the rat race, having other people or other entities generating your cash flow. All of it goes into the line of credit. All of it goes through the periodic monthly payments and pays off that amortized mortgage. Who benefits here? It's all you. You've taken those other companies, the other entities, the Wall Street banks, corporations, and governments out of the equation. And now you benefit from your cash flow. This is your life tomorrow if you work with us. Now, let's take a look at some actual numbers. This is a velocity banking demonstration calculator. This is a $280,000 mortgage. If you go up to the top, you have 4 different scenarios. You have the blue box, which is a standard debt. We're going to call it a mortgage. The amber box is actually the debt with making extra payments. This is what a lot of the radio gurus and your financial planners will teach you to do, and that has some merit. So let's take a look. 30-year mortgage, $280,000 at 5%. This is 30 years. Your free cash flow, and we're going to talk about that, is $1,000 a month. If you just pay that mortgage off, you'll pay $261,000 in interest, and you'll pay it off in 30 years. Great. If you were to make an extra $300 a month payment, this is just extra principal, you're going to lower your free cash flow, meaning you're going to nip into the money you have available for life. But you will pay that off in just under 21 years, and you'll save $89,000 in interest. So let's go through the numbers, right? Now, if you learn velocity banking, our basic velocity banking concept, and in this case, we're talking about a $1,000 free cash flow. What matters is your cash flow. What's your net income, meaning the money you take home, minus all of your expenses, gives you the free cash flow, which is the money you would have available to put into a checking account or a savings account at the end of the month. If you just use the structure that I showed on the previous slide with your existing budget, you would pay that mortgage off in 13.25 years and save $169,000 in interest. So let's look at a return on investment of this. If you were to get our essentials classes, which only one of the 10 classes is this velocity banking. You'd have 9 other classes on taxes, on real estate, on retirement plans, but your $2,000 investment would result in $169,000 savings, so that's an 8,300% return on your investment. Folks, I challenge you to find anything else that will produce that type of return on investment. But if you continue to educate yourself and become even higher efficiency, you can use our advanced strategy. And in the advanced strategy, you would pay it off in 11 years and save $190,000 in interest. And look at this. You would actually increase your cash flow. See how cool this is? This is amazing. But they don't teach you this in school because they want you to pay a ton in interest. So if you were to get our Extreme Combo package, which teaches the advanced velocity, and this is used for investment properties, this is used to build wealth as well as just get out of debt. On a $20,000 investment, and this is a lifetime investment in education, you save $190,000, your return on investment is 851%. Now, let's look at behind the chart. So these are the actual tables that generate the numbers on that graph. This is a standard amortization chart, 30-year mortgage. Notice at the top, it's a $280,000 note. And if you pay this for 48 months, you would pay it down to $262,000. You'll have paid off only $17,000. Now remember, you made 48 payments of $1,500. So that's like $72,000 worth of payments to pay off only $17,000. If you were to use the velocity banking system, this is just the basic system, right? The green box, $280,000, but you would be chunking payments from that line of credit, remember the periodic payments, into that mortgage, so that at the end of 48 months, instead of $17,000 paid off, you'll have paid off $72,000. But it gets better. Let's look at this as we continue on. We're going to start with month 126, which is 10.5 years. So at 10.5 years under the 30-year mortgage, you would still owe $224,000. Yet, with velocity banking, you would only owe $70,000. And in month 157, you would have actually still owed $206,000 under the old way, but you would be paid off under the velocity banking system. So which would you rather have? The blue box, which you'd still owe $206,000, or the green box, which you would have paid off? It's your choice. And it's just by understanding how the system works and implementing a couple of basic strategies that you're not taught in school. Okay, now the requirements for velocity banking are you must have positive cash flow. In fact, if you don't have positive cash flow, you've got a bigger problem, which is you're going broke. Now, we can teach you how to get positive cash flow. We have income systems within our community that you can take advantage of to get positive cash flow. It's best if you have a good credit score because you have better options. However, we also will teach you how to use this even with challenged credit, and then learn to improve your credit score to get the optimum results. And folks, the velocity banking strategy is just one of these 10 classes in your essentials. No financing is required. In fact, stop refinancing. It is a scam. You're getting hurt. And no equity in your property is even required. But you must study your classes and attend the coaching sessions before implementing these strategies. Folks, you gotta learn what you don't know, because most people, they don't know what they don't know. Okay, so the benefits, though, potentially save hundreds of thousands of dollars in interest, pay off your installment debt, get out of debt. You can make payments to and withdrawals from lines. So if you ever need the money, you can get it back. Your credit score will likely improve because when banks see you using lines of credit, they know you are financially literate and they will increase your lines. See, lenders will want to increase your lines. Lines of credit can actually be immediately withdrawn. So if you make a payment on a mortgage, you can't get it back. But if you make a payment on a line of credit, the next day you can pull that money back out and you can do what's known as float debt. This will be helpful when you're actually investing. Okay, we don't want to talk about that right now. Line of credit utilization rates are not factored into calculating credit scores. So if you're familiar with credit scores, if you draw your credit cards too far down, it will hurt your credit score. In lines of credit, they don't look at it that way. They're handled differently. You always have access to the funds if you need them. So when you're parking money in that line of credit, if your car breaks down or you have a life event, you don't have to go borrow money. You just, well, you borrow it back from your line of credit. It's your own line, right? So pay off your student loans, your credit cards, your car loans, and eventually rental real estate using the cash flow from other people. So it's not you going to work anymore. It's folks going to work for you. So let's take an example. Let's take a look at that calculator a little more in depth. I think you'll find something really interesting about it. So I'm going to come over here and I'm going to pull up the debt acceleration calculator and I'm going to drag the screen over so that you guys can see what we're doing here. Bear with me for a second. Okay, so we're looking at the debt acceleration calculator. Remember, $280,000, 5%, 30 years. Now, here's where things really get interesting. Remember I told you that cash flow is everything? So if you're taking our classes and you learn from our tax and legal classes how to reduce your taxes by $300 a month, let's see what your numbers become when you decrease your expenses by $300. So I'm going to go from $5,500 to $5,200. And remember, you're at 13.25 years and $169,000 in savings. Now you're at 11 years and $177,000 in savings. Do you see how much better things got? And it's all about cash flow. But it gets even better because the way to juice your cash flow is 1, lower your expenses, but 2, increase your income. So we have an income system where just by showing off what I'm showing you to other people, you could earn on an essentials sale, which is a $2,000 sale, you can earn $1,000. So let's say you helped find folks that could benefit from this, and there's people all over that could benefit from this, right? Brothers, sisters, uncles, friends, families, people at church. And you go from a $6,500 a month and you make an extra $1,000, so you go to $7,500 a month. Right? Not another job, just showing off what we're doing. Look at these numbers. You just went down to 8.5 years for a payoff, and you're going to save $202,000. And look at the returns on investment down here. You now are talking about a 10,000% return on investment. Folks, this is a return on investment. You don't have to do a fix and flip. You don't have to do a buy and hold. You've already dug the hole with the debt. We're just giving you this incredible ladder to get your way out. And you could share it with other people. Isn't that amazing? Okay. And now let's go back to the PowerPoint presentation. Oops, that's not the PowerPoint presentation. Let me get rid of that. So PowerPoint's right here. So let's go back and now we're going to go, hold on a second, from this slide. Okay, so let me get the screen lined up. I know it takes a couple of seconds here, no big deal. Okay, so we talked about the benefits, right? We looked at the calculator. Now, let's talk about once you get out of debt, how to use this whole system to create instant wealth and passive income through real estate investing. So, if you work 40 years right now for a job, how much can you sell your job for? Well, the answer is 0. Can you leave your job to your family when you die? No, it has no value. You're just making somebody else rich. So let's stop letting other people take control of your life and your future. Get out from the clutches of Wall Street, the banks, corporations, and your government. Take control of your future. Acquire one little rental house per year for 20 years. Simple, easy peasy. You're going to buy it at a discount because we're going to teach you how, and then you're going to create wealth on day one. So if you buy a $100,000 house for $30,000, and it happens all the time, I do it all the time, you're going to create $70,000 worth of equity, which is wealth, with the stroke of a pen. How long do you have to work for $70,000? Your tenants will gladly pay off the property because you're going to create value for them, and the rents and the values will adjust for inflation. Now, how much are those 20 houses, free and clear, worth? Well, at $100,000 a piece, they're worth about $2 million. Can you leave your properties to your heirs? Yes, tax-free. Most importantly, how much cash flow will 20 properties generate? How much will 20 free and clear properties generate? Hold one second. Well, it's pretty easy to take a free and clear property and generate $500 a month. In fact, that's really easy. Times 20, there's $10,000 a month in positive cash flow forever. You're not going to deplete your nest egg. You will pass this on for generations. And do you think there'll be more or less demand for housing in the future? Of course there's going to be more demand. So use the velocity banking system that we just showed you to pay off these properties using cash flow from your tenants, not your own work. Okay, so let's talk about a cash flow-based retirement plan. Everybody has been taught to base their retirement and their lives on assets and liabilities, asset-based retirement versus cash flow-based. But let's look at what wealthy people know. Poor people and middle-class people, they focus on savings. They're in a scarcity mindset. They're giving up. They're doing without. They're scrimping and saving. In fact, if you go with the scarcity mindset, you will need $2.4 million to make that $10,000 a month for 20 years. How's that savings going? How are those accounts doing? But wealthy people have learned to create value rather than try to save their way to prosperity, and that's an abundance mindset. It's an infinite situation when you're creating value. Asset-based or middle-class and poor people focus on avoiding taxes, whereas wealthy folks are maximizing cash flow. Because we don't tax cash flow, we only tax income. Oh, this is a big point. If you're going to do an asset-based retirement, you better be starting 30 plus years before retirement. You are totally dependent upon compounding interest and growth. Cash flow-based retirement is ideal for folks nearing retirement. If you're in your 40-somethings or 50-somethings, you don't have enough time to save your way to retirement. It's too late. You need Plan B. Now, what happens is, under the asset base, this is what your financial planners teach you to do. They teach you to buy assets at full value, stocks, bonds, mutual funds, and then hope that they go up in value. What cash flow based folks and wealthy people realize is you buy or control assets at a deep discount. You buy those little houses at 20, 30 cents on the dollar, so you triple your wealth instantly. How long does it take you to triple your wealth under this other old model? Asset-based middle-class folks are obsessed with liquidity. That's why people aren't successful. What do? When the market's going up, they buy. When it gets to a top, they're buying, and then when it crashes, they sell. Happens all the time. And that's why their accounts that's why they're never successful, because their emotions work against them. Under cash flow-based retirement, cash flow is liquidity. You're calm. You control your own destiny. You're generating cash flow from your own assets. You're not looking for some greater fool to buy your assets during a crash. This is huge. Under the old model, asset base, you have to be old to retire. Whereas in cash flow base, there's no reason you have to be old to retire. You just retire whenever you get enough cash flow going. Under the old model, which you're being taught, your nest egg, when you retire, it starts to become depleted. You're burning through your money. You're burning through capital. You're eating your nest egg. Under the cash flow based model, you're only living off the cash flow, so your portfolio is actually growing. And the difference is, under the current way, Wall Street, the banks, and the corporations and the government control your retirement, and that's full of stress. Whereas under the newer way, which is cash flow, you control. And that leads to a lot less stress and confidence. So let's look at an example of cash flow versus assets. This little house is worth more than $500,000. This is just a little 1,200 square foot brick house in Georgia. I actually own this. I paid 28 grand for it. It's worth 80, and it rents for $650 a month. Okay, and we'll teach you how to do this. $500,000 in the bank is where you're getting about 1% right now from CDs. That will generate $416 a month for you to live on. Whereas this little $28,000 house will yield $500 a month. So a $28,000 house is worth more than $500,000 in the bank. But it gets better. The $500,000 in cash is depreciating. It's known as inflation, folks. Your purchasing power is always going down by design. Whereas the house appreciates, right? $28,000, now it's worth $80,000. That's 185% appreciation. You can't buy cash at a discount. In fact, you probably had to pay taxes on this. So you maybe had to make $700,000 to have $500,000 in the bank. Whereas you can buy properties, especially rental real estate, at pennies on the dollar. In fact, if you're really good, you can actually control properties and never actually buy them or pay any money for them. So that would be an infinite return, right? Infinite cash flow. Again, the old way is you concentrate on avoiding high taxes, whereas under the new way, you're looking for big write-offs, and the government gives them to you. And again, go back to the velocity banking strategy and use that strategy with other people's money, other people's cash flow to pay off your houses. Okay, why didn't we learn this in school? I get asked this all the time. Wait a minute, I have an MBA I paid $100,000 for and I didn't learn this. Well, the reason is we don't teach this in school. I have 3 college degrees and I didn't learn this. In fact, you're being taught by employees. Your professors are just employees. Many of them are state employees, so they're teaching you to become another employee. Banks earn billions from the 30-year mortgages and refinancing scam that's been going on for 30 years. And Wall Street earns billions more in fees because you think you need them to manage your money. Do you see how foolish this is? Letting other people manage your money? Your teachers, your parents, your role models were most likely W-2 employees, meaning they didn't know this either. And governments collect much more taxes from financially illiterate workers and low velocity or low financial velocity people. Much more money. If you know what you're doing, you're going to be paying 10% of your cash flow in taxes rather than 33%. And this is really insidious. You know that most students graduate deeply in debt due to student loans, and student loans are the only debt, not the only debt, but almost the only debt, not extinguishable by bankruptcy, meaning the banks, along with the government, are guaranteed their money. And that allows schools to charge outrageous tuitions. That's why colleges are so expensive. That's why your kids are coming out and they're broke and they're dependent and they're living in their parents' basements. And here's a button that I saw that was great. You got to get this for all your college friends. I'm broke and I have a degree to prove it. Isn't that the truth? Guys, gals, you don't know what you don't know. Hopefully this shows you a glimpse of what the other side is like. Okay, so who can benefit from this knowledge? Now, if you're going to learn this, you and your family, this will change your family's financial trajectory. How about graduates with excessive student loan debt? How about everyone you know? How about your brothers and sisters and folks, everyone that's in debt can take advantage of this. Realtors and real estate professionals. If you're a realtor or a real estate professional, please get in touch with the person who gave you this video and then let's have a three-way, let's have a conversation. Think of the value you could offer to your clients at the closing table. Instead of just saying, hey, congratulations on that new house you bought, say, hey, how would you like to help pay off that mortgage in about 1/3 the time and save $160,000 in interest? Wow, that's a great conversation. Mortgage brokers and lenders, because mortgage brokers are about to have a problem with their business. The refinancing bonanza that's been going on for 25 years is coming to an end. Interest rates have reached a bottom, so it makes no sense in refinancing. you can now offer your clients velocity banking. CPAs, financial planners, tax professionals, did you hear about this from a CPA or your financial planner? No, you had to hear about it from me. What does that tell you about the knowledge of your CPAs, your financial planners, and your tax professionals? Pastors and counselors, do you have a pastor at a church? Somebody who's got a congregation of maybe 100, 200, 500, 1,000 people who could benefit from this. What a great presentation. And you can earn while you learn and help others. That's the goal. So, take the next step. Contact Mike Harrington, CEO of National Real Estate Investors Group. You can call him at his number, or you can email him at his website. And, I want to go back. And get with Mike, have a conversation, learn more about what we're doing, and then change your financial trajectory. My name is Bill Omi. I hope to be working with you soon, and it's been my pleasure to do this webinar tonight. Good night.